Can you believe it? In America, an entire generation is entering retirement with a median debt of $32,000. But here's the twist. It's not because of luxury cars or exotic vacations. Instead, they're trapped in a brutal financial vice. On one side, adult children who can't leave the nest. On the other, aging parents requiring expensive care. This is the grim reality of the sandwich generation. Why is their golden age turning into a debt trap? Let's find out. Why is this number skyrocketing so fast? Let's look deep into what's actually happening in households with fixed incomes. When we talk about debt, we usually picture a 20-something graduate struggling with student loans or a young couple overextending themselves for their first home. But the data tells a much more disturbing story. Recent financial reports have pulled back the curtain on a demographic we once thought was safe: retirees. Currently, a significant share of seniors is carrying a median debt of about $32,000. On the surface, you might think, okay, $32,000? That's just a car loan. But look closer. This isn't low-interest mortgage debt or manageable installment loans. The primary culprit here is high-interest credit card debt. While debt levels for younger generations have actually stabilized or even dipped in some sectors as they tighten their belts, debt for those aged 60 and over is climbing at a pace that should make every economist shudder. In fact, over the last decade, the rate of debt growth for retirees has outpaced every other age group. But why? This brings us to a term you need to know: the sandwich generation. Historically, the sandwich generation referred to middle-aged adults, people in their 40s and 50s who were squeezed between supporting their growing children and caring for their aging parents. But a massive shift is occurring. Because of rising inflation, a brutal housing market, and the skyrocketing cost of education, that squeeze is lasting much longer. We are now seeing senior sandwich households. These are retirees who, instead of enjoying their golden years, are still financially tethered to their adult children who can't find a footing in this economy. At the same time, they're responsible for their own parents who were living longer than ever, but often without enough savings to cover specialized medical care. Think about the math for a second. If you were on a fixed income, maybe a social security check or a modest pension, your monthly revenue is a flat line. It doesn't go up. But the interest on that $32,000 credit card balance, that is a shark that never stops swimming. When the cost of eggs, gas, and electricity goes up, but your check stays the same, the credit card becomes the only way to fill the gap. It starts with a few $100s for a grandson's textbooks, then $1,000 for a parent's dental emergency. Suddenly, the interest kicks in, and that convenient plastic card turns into a financial black hole. The $32,000 figure is just the tip of the iceberg, because it only counts what is owed. It doesn't count the opportunity cost, the money that should have been spent on a retiree's own health, comfort, or long-term care. Instead, it's being siphoned off by banks at 20 or 25% interest rates. This isn't just a bad luck story, it's a systemic trap. We are witnessing the erosion of the American retirement dream, replaced by a cycle of perpetual borrowing just to keep 3 generations afloat. It feels illogical, doesn't it? That those who worked for 40 years are now more financially vulnerable than when they started? But as painful as the debt numbers are, the reason behind the spending is even more complex. Because when you ask these retirees why they are swiping their cards, the answer isn't greed or luxury. It's something much more personal. Which brings us to the first gank of the vice: the children who simply can't or won't leave the nest. In a perfect world, retirement is the finish line. You've put in your 40 years, you've raised your kids, and now it's your turn to rest. But for the sandwich generation, that finish line has been moved. Today, parents aren't just celebrating their kids' graduations, they're subsidizing their adult lives well into their 30s and 40s. We are seeing a massive surge in what economists call failure to launch. But let's be fair, the economy for young adults today is brutal. High-sky rent, entry-level wages that haven't kept up with inflation, and a mountain of student loan debt. So what does a loving parent do? They open the door, they set a place at the table, and then they open their wallet. It starts small, covering a phone bill here, a car insurance payment there.
But it quickly escalates. We are now seeing retirees dipping into their 401ks or taking out home equity lines of credit just to help their children afford a down payment on a house or to pay off a high-interest private student loan. The tragedy is the math. A 25-year-old has 40 years to recover from a financial setback. A 68-year-old has 0. When a retiree takes on debt to save their child, they aren't just spending money, they are burning their own safety net. They are trading their medication budget for their son's credit card bill. They are trading their heat in the winter for their daughter's car payment. And here is the critical critique. Sometimes this help becomes a form of financial enabling. By shielding their adult children from the harsh realities of today's economy, parents are inadvertently transferring the crisis to themselves. They carry the $32,000 debt because they can't say no to a child in need. It is a sacrifice born of love, but executed with zero margin for error. We see retirees returning to the workforce, taking part-time jobs at 70 years old, not because they want to stay active, but because their adult children still need a monthly infusion of cash. It's a heartbreaking reversal of roles. Instead of the child supporting the aging parent, the parent is exhausting their final resources to maintain the child's lifestyle. This isn't just about money, it's about the erosion of independence. When a parent becomes the permanent bank, the traditional cycle of life breaks down. The parent never truly retires, and the child never truly becomes an adult. They are both stuck, anchored together by a chain of debt that grows heavier with every passing month. But as heavy as this burden is, it's only one side of the vice. Because while these parents are looking down at their children, they are also forced to look up at the generation before them. The generation that gave them life is now reaching an age where love isn't enough, where they need professional, medical, and constant care that costs more than any pension can provide. But that's only half the truth. The real burden lies on the opposite side of the timeline. While the sandwich generation is looking down at their struggling adult children, they are simultaneously forced to look up. Their own parents are living longer than any generation in human history. This should be a blessing, but in a world where medical costs are outstripping inflation, it has become a secondary financial gank. According to data from the Federal Reserve, healthcare expenses are one of the most volatile and destructive forces hitting senior households today. We aren't just talking about a routine checkup or a bottle of aspirin. We are talking about specialized memory care, long-term physical therapy, and prescriptions that can cost thousands of dollars a month. When a 90-year-old parent needs immediate care and the insurance falls short, the 65-year-old retiree doesn't have time to wait for a bank loan. They do what is fast. They do what is desperate. They swipe the card. In this moment, the credit card ceases to be a tool of convenience. It becomes a virtual life support system. People are literally charging their parents' survival to a piece of plastic with a 24% interest rate. It's a tragic math equation where the cost of keeping a loved one alive is the destruction of your own financial future. But this burden isn't distributed equally. If we look at the reports from the National Council on Aging, the cracks in the system become even wider. There is a deep systemic disparity here. Women and people of color in the sandwich generation are hitting a breaking point much faster. Why? Because of the cumulative wealth gap. Women, who historically have taken more time out of the workforce to provide unpaid care, often enter retirement with smaller pensions and less Social Security. Now they are the primary caregivers again, this time for their kids and their parents. They are doing double the labor with half the resources. For minority households who may have had less access to home equity or generational wealth, this $32,000 debt isn't just a hurdle, it's a terminal diagnosis for their independence. It is the direct path to homelessness and old age. We have to ask ourselves, how did we get here? How did the golden years become a choice between buying your own blood pressure medication or paying for your mother's hospice care? The data from the Fed and the NCOA isn't just numbers on a page, it's a warning of a social collapse. When the middle generation, the one that should be the stabilizing force of the economy, is hollowed out by debt from both ends, the entire structure begins to lean. They are being drained of their liquid assets, their home equity, and most importantly, their peace of mind. They are living in a state of constant financial triage, deciding which fire to put out first, while the interest rates continue to fan the flames. But as overwhelming as these two ganks, the children and the parents feel, there is a silent partner in this debt trap, an invisible force that turns a manageable debt into an inescapable prison. Which brings us to the final piece of this dark puzzle, the trap of compound interest, and why, for a retiree, $32,000 isn't just a number, it's a wall that is getting higher every single day.
To understand the danger, we have to talk about the math of despair. When you are 25 years old and you carry debt, time is your ally. You have decades of potential raises, promotions, and career pivots ahead of you to outrun the interest. But when you are 65, time flips. It becomes your most aggressive enemy. At retirement, most people transition to a fixed income. Whether it's Social Security, a pension, or a structured withdrawal from a 401k, your monthly revenue is essentially locked. It's a flat line. But credit card interest is anything but flat. With average rates hovering around 20 to 25%, that $32,000 balance is generating over $500 a month just in interest alone. Think about that. Before you buy a single bag of groceries, before you pay for electricity or your heart medication, the bank has already siphoned off $500 of your fixed check. If your total income is $2,500 a month, you've just lost 20% of your purchasing power to a ghost expense. This is the erosion of the golden years. It's a slow-motion collapse where the interest eventually consumes the principal income, leaving nothing for survival. And this is where the psychology of blind sacrifice becomes truly dangerous. Many parents in the sandwich generation believe they are being noble by taking on this debt for their children or parents. They think, I'll just tighten my belt. But you can only tighten a belt so far before it breaks. Unlike a younger worker, a retiree cannot simply work more hours to cover a spike in interest rates. Physical limitations and the ageism of the job market mean that once you fall behind the curve of compound interest, catching up is mathematically impossible. This is how a middle-class retiree, someone who owned a home and lived a respectable life for 40 years, ends up facing the terrifying reality of elder homelessness. It starts with credit card surfing, moving balances from one card to another to chase 0% offers. Then it moves to payday loans or high-interest title loans. Finally, the house, the one asset meant to be the ultimate safety net, is sold or foreclosed upon to satisfy the creditors. The dream of leaving a legacy for the next generation evaporates, replaced by a shared poverty. We have to call this what it is, a structural failure of the American dream. We were told that if we worked hard and saved, the end of the road would be paved with security. But for the sandwich generation, the road has turned into a treadmill that is moving backward. Their blind sacrifice isn't just spending money, it's a transfer of poverty. By ruining their own financial health to save their children, they're ensuring that when they finally run out of resources, their children will have to foot an even larger bill for their care. It's a cycle that doesn't end, it only compounds. The golden years were supposed to be about reflection and peace. Instead, they have become a high-stakes battle against a calculator, a battle that for many is already lost before the first check of the month even arrives. But as grim as this reality feels, we cannot afford to look away. Because the question isn't just how did they get here? The question is how do we stop this from happening to the rest of us? Which brings us to our final reflection. If the system is broken and the math is rigged, what is the one thing we can actually control? The reality of the sandwich generation is a haunting reminder that debt in retirement isn't just a personal failure, it's a symptom of a deeper systemic and cultural crisis. We've been raised to believe that self-sacrifice is the ultimate form of love. But as we've seen, when that sacrifice is blind to financial reality, it doesn't save the next generation, it simply ensures that both generations sink together. The $32,000 median debt we discussed isn't just a balance on a statement, it's a warning light. It tells us that the traditional golden years are under siege. To protect ourselves and our families, we must start having the hard conversations. We must learn to set financial boundaries, even with those we love the most. Because at the end of the day, you cannot pour from an empty cup, and you certainly cannot provide a safety net for your children if you are one medical bill away from losing your own home. We have to redefine what it means to help. True help isn't just swiping a credit card to put out a fire today. It's ensuring that you remain financially independent so you don't become a burden tomorrow. So we want to hear from you. This is a difficult, emotional topic, but it's one we can no longer afford to ignore. If you were in this position, would you continue to provide financial support to your adult children, even if it meant drowning in debt? Or would you put your own oxygen mask on first to ensure your long-term survival? Share your thoughts in the comments below. Your perspective might just be the reality check or the piece of advice that someone else in this exact situation needs to hear today. Don't forget to like and subscribe for more deep dives into the forces shaping our world. Thanks for watching.